Hi, I'm Trevor Dale. I'm the founder of TK Dale Wealth Management and the creator of MillionDollarMortgage.com. So today I'm going to talk to you about tax-free savings accounts. That's TFSA. Everybody else always says TSFA. It is a tax-free savings account. So 3 times are when it's optimal to use and TFSA, and it's a great new product that came out. The government has allowed money to go in, and let me just generally explain what that is. So you can take your money, you can put it in. The growth that happens inside that is not taxed. You can then withdraw that and then not receive any sort of taxable benefit or any sort of taxable income on that portion. So there are some rules around it, but I'm going to talk more generally in terms of when to use a TFSA. So before I get into this, let's do the lawyer thing and know that this is not meant as individual advice specific to you, but is meant as educational purposes only. And if you look to act on any of this information, I recommend that you seek the help of a licensed professional prior to doing so. Okay, so now we got the lawyer thing out of the way. If you are debt-free, you may want to consider using a tax-free savings account. And I'll explain that in a minute. If you have registered accounts, but your pension or you're already maxing out your RRSPs, you may want to consider a tax-free savings account. If you expect yourself to be high income in retirement, then you may want to consider using a tax-free savings account. And the reasons is that if you are high income in retirement, the old age security can actually get clawed back if you're over a certain amount. If your registered accounts are maxed, you don't really have anywhere else to put your money. But if you have debt, now let's take a look at this. So you have a mortgage here with debt, and you may have RSPs, you may have savings, you may have other types of investments, you may just have cash in somewhere else, you may have a locked-in retirement account, and all of these things will contribute to your assets, and then you look at your debt. Now, it's an interesting thing that often people don't think about. So when you're looking at RSPs and you're planning for your rainy day, in the event that you're laid off, you will likely have a lower income in that year. If you have a lower income in that year, you may actually want to withdraw from your RSPs because it will boost up your income, which you don't always want to pay taxes on, but you can use that as a source, and in a lower income year, that actually makes sense. So it can act as a rainy day fund, even though that's preparing for the future. Now, you may also have a locked-in retirement account, a pension that you cannot touch. In that case, don't worry about it. It's on its own. It's kind of an outlier, and it's a really sad thing when you end up with a $30,000 pension and it can't do a whole lot. You can't consolidate it. There's not a lot you can do unless you want to unlock it under certain things like financial hardship, on other things like that. There's not a lot you can do. If you have cash and savings and you have a mortgage, you may want to take this cash and savings and put it here to pay down your debt. And what will happen is you will start to pay this down. Now, here's the tricky part. You may want to consider using a home equity line of credit. That is a home equity line of credit. And what that does is that it's readvanceable. So as you pay this down, you can then go and withdraw it. So you may be thinking, well, if you're thinking holistically as a unit, as a family unit, that you've got your emergency funds in cash and they're separate from your line of credit, they're not earning a lot in savings or cash. Your line of credit, you're paying usually these days prime plus a half, maybe prime plus 1. Typical going rate today, if you're going to issue a new one, is about prime plus a half. This is because you can now pay this down faster. So if you lump this into here and pay it down, you may feel like you don't have any savings, but this is your savings that you wouldn't have otherwise. I'm going to talk to you about one more strategy too. So if you put your paycheck into here and you're not spending your whole paycheck every month, immediately it will decrease it and then it will slowly get drawn on throughout the month. You'll pay it again next time you get a paycheck and it will slowly increase. This can help you pay it down faster because you're paying daily interest. Sorry, that's daily interest, right? Whereas on your mortgage, it's slowly being paid down. This is being paid down faster. You're going to charge on the daily interest, and that's a strategy which I will talk about in the future. I can help you out with that because I'm a mortgage agent with iBridge Capital under that registration, and we can look at using different products for that. There are some out there where it is intended to be a checking account. So this is something to think about. So if you are debt-free and you don't use this strategy, you've maxed out your RSPs and you're concerned about high income and a clawback in your old age security and the clawback that happens in that, you may want to consider a TFSA. If you're a non-homeowner, you may also want to consider it, considering these other things. But if you're a homeowner and you have debt, even if you've already maxed out your registered accounts or you may be high income in retirement, this would be a better strategy for you. So using a line of credit as a checking account to immediately pay it down, you're paying in daily interest, and it is just what you're being charged, and then it will help you pay down debt faster. And I've come up with a model where I can quickly assess at what level of line of credit you need to have and how much mortgage you need to have and what the interest rate is on one and what the interest rate is on the other, and at what point it's advantageous, even if this interest rate is higher than this rate. Because if this is higher, there's still a point when it's still an advantage to do this because of this daily checking cash flow benefit that you're getting. So tax-free savings account, absolutely fantastic. The other thing too is if you have money or you have stock, for example, I'm going to give you one last one. If you have stock that you have waiting inside and you cannot contribute into your RSPs, but you're waiting to contribute it into your RSPs, you may want to drop it into your TFSA if you have the room. And then when you're ready and the new season opens up and you get more room for the new year, that's when you then shift it to your RRSP. Okay, so that may be a good holding ground for stocks. So keep these in mind. I hope this is helpful. I'm not down on TFSAs. It just has to be the appropriate time. There are other strategies that you can use first and things that will help out in the future. So if you have any questions, give me a shout. I'm always happy. Post below if you have any questions, and we'll talk to you then. You can always find us at tkdale.com/podcast. You can find me on iTunes, Spotify, Google Play, and Stitcher under the TK Dale Wealth Podcast. And of course, we're on YouTube if you're watching this. Thanks for watching. Thanks for listening.